Good morning, everybody, and welcome to Beat the Bell, presented by Kane Capital. It is the last day of trading in 2023. Today, I'm going to be reflecting on my trading year, on all the things I did right, all the things I did wrong. You're either sitting in a position where you're very, very happy with the way you traded. Most people probably aren't. That's just the nature of the game, especially in what has been a very, very difficult market to trade. One of the toughest years in the market in all of history, as we know. But let's get into it, guys. I mean, whatever you think about your 2022, wash it, whether you did well, whether you did poorly. The new year is just around the corner, and it's time to make things happen. Let's get to the panel now, guys. We've got Diamond Trades with us. Good morning, Diamond.
Alejandro, what's going on? Last day of the year, last day to Beat the Bell. Excited to get after it.
All right, Ramsey Rippers.
Good morning, brother. Last day of the year. It's a chilly one in my apartment. We're rocking with the flannel popped collar this morning, ready to go.
Yeah, you look good. And we've got Mo Mamba.
Good morning, guys. Yeah, it's been a great year, man. Been a really good year. I learned a lot this year. You never stop learning in this game, so it's a tough game, but never stop learning no matter how long you've been in it and no matter how good you think you are. So it's been a great year, but this last week has been pretty terrible, but we'll get into that.
Yeah, they really put the icing on the cake. I was talking about it yesterday on my Twitter. I was on the Wolf Spaces. I was telling everybody in the Discord. I don't know why this week was very, very frustrating. I mean, if you look at the chart, and it's so funny when I woke up this morning, because yesterday I was kind of playing in my head. Like I didn't trade yesterday, but I was like, what would I have done if I decided to trade the futures? And I had bullish bias coming into today, and I wake up and we're gapped down, and I'm like, that literally just tells the story. Like nothing kind of made sense this week. It isn't a liquid week, obviously, the last week of the year. I think that the Santa rally bias may have gotten a lot of people in trouble. But let's get into our Fed forecast here with Diamond. Noah, what do you got for us this morning?
Yeah, so let's start with the economic calendar. So still for today, we've got Chicago PMI coming out at like 9:45. I think that's going to be the last relatively significant piece of news that we get here in 2022. And then obviously we're going to head into next week. But let's take a look at the calendar for next week, because next week is actually going to be a pretty busy one to start off the new year. So on Monday, obviously the market is closed for the New Year's holiday. It'll be observed on Monday, so the markets will be closed. Tuesday, we're going to get S&P PMI, medium impact news. On Wednesday, ISM PMI, JOLTS, so the job openings report, and the Fed minutes release. So they're going to do their minutes release from their December meeting. So that'll be important to pay attention to. Thursday, we're going to get balance of trade. And then Friday, we're going to get non-farm payrolls, which tends to have an outsized impact on the market. So we should get a decent amount of news-driven volatility in the first week of 2023. So that's number one. After we take care of that, I think that's pretty much going to be it for next week. Yeah, it is. Okay. So one of the things I wanted to do today here on the last day of the year is sort of put the year into context, right? We've had a really wild 2022, right? It's obviously been a historic one for the record books, particularly volatile and painful year, right? For investors in 2022, which is really a sharp turnaround from like that euphoria that the markets were experiencing in the latter half of 2020. And all of 2021. So I think three key points really highlight that fact. And we'll start with the fact that this year had the most red days of 1% or more in the S&P 500 since 2008, right? So the year was haunted and characterized by these really steep sell-offs that we would get after sort of building up hope. The market would build up hope and rally on the thoughts of a Fed pivot, right? And you could just see over and over again that those pivots were just those pivot rallies were just getting crushed time after time after time. This is one of the worst years since 2008 for downside volatility. As you guys can see here, 24% share of trading days at the S&P 500 closed down at least 1%. So a lot of volatility to the downside this year. And I know there were really just some awe-inspiring drops in the market, right? Like we would be selling off, and we're like, how is the market still going down? It felt like that was just a common theme throughout the year. Another point to make here is that outperformance of defensive stocks, right? So looking at the sectors that performed really well after 2022, I mean, after 2020, after 2021, it was obviously a different investing environment, but all of our favorite tech stocks, the zombie companies, as people like to call them, all those names that are sort of in that ARC basket would just rip 200-300% from their COVID lows. This year was definitely marked by a outperformance of defensive stocks. Sectors like consumer staples, healthcare, and utilities posted their largest outperformance relative to the rest of the S&P since 2008. So again, we had a situation where the market dynamic was different than anything that we've seen really in the past decade. So amidst the carnage that we saw in tech, with a lot of those stocks down 30, 40, 50%, we saw a lot of investors sort of flee to some of these names to have a bit more dependable earnings and cash flow. Obviously, as the economic environment gets more and more uncertain, right? So those stocks were a beneficiary of that sort of movement. We'll see if that is going to continue into 2023. And the last point that I wanted to make that really, I think, highlights how difficult this year was is that this was one of the worst years on record for the 60/40 portfolio. So for those who don't know, it's build is one of the most tried and true methods of sort of investing, right? You put 60% of your money in stocks, 40% of your money in bonds, so that when stocks are going down, bonds are going up, you're protected. When bonds are going down and stocks are going up, you're protected. This year, both went down, right? As stocks sort of cratered and yields rose, this is a very unlikely situation. And so most 60/40 portfolios were down about 7%, 17% this year, right? So that's unheard of, right? Seeing that type of move in both bonds and equities, I think really caught people by surprise this year and caught some folks off sides. The one point that I will make is that if you look at the last 10 years, including this year's loss in that sort of 60/40 portfolio philosophy, you're still averaging about 6.5% year over year return, sort of showing you that this strategy does its job in the long term, right? Like even though you will have anomaly years like this year where both bonds and stocks are down, I think in the long run, this sort of strategy is a bit worth its salt here, as you guys can clearly see over the past 10 years, still showing solid performance and solid safety. So not necessarily to say the 60/40 portfolio is dead, but just highlighting the fact that this really was one of the worst years, regardless of sort of your investing strategy, whether you're a shorter term trader or a longer term investor. 2022 was really difficult. For a lot of people. And I think in this situation, the 60/40 situation, like the rest of 2022, really just highlighted the importance of risk management, right? Like not being over leveraged and things that you really believe in, right? Because clearly we've seen this year that when the environment changes, the market doesn't care, right? The market doesn't care. The market will flip aggressively, right? So you got to make sure that you're managing risk at all times, even when things look great. So that's going to wrap it up for us here on Fed forecast to close out 2022. We'll pass it back to Alejandro.
Thank you, Noah. What a year it has been. When the 60/40 isn't performing, that's when you know things are actually tough. All right. The system, guys. Let's talk about it. So, obviously, last Friday is Tuesday, lots of chop. You actually could have made some winning trades this week just by following the system. So, Tuesday was difficult because things were kind of chopping around. On Wednesday, we did get the sell-off, okay? I was actually short in that trade, so that was actually a nice trade. I mean, I was up maybe 20 points in profit and just didn't get followed through into the next day. So let's say you had taken some profit. That's 20 points. I saw a lot of people who were trading the options were actually doing really well. And so that was a day where being in the options was extremely advantageous versus trading anything else. I was trading SPXU commons, just shorting the S&P. The futures would have done well. And then let's say you had taken your profits and the next day you take the break over the 50 SMA. That gave you what? Another another 25 points or so. So those were a couple winning trades, but my style of trading and the way I like to do things, I'm not interested in 20 points of profit. Okay. And that's not to sound like, oh, I'm looking for a home run every time, but I like to keep my take profit and my risk management in general um pretty consistent regardless of kind of what's going on. And I don't like to, because of the market environment, I don't like to turn into a scalper, and then when things are better I turn into a swing trader. I'm kind of always swinging, looking for those bigger plays, and if I recognize that the market isn't really providing that sort of opportunity, what's going to happen is I'm just not going to trade. And that's what I kind of figured was going on pretty early this week. And so the sell off and then the gap up on the jobs report, that to me was just kind of telling. And then we look at what happens today. We get the break over this giant range on SPX, this 38.45. We're flagging above it. Everybody starts to get bullish again. Here comes the Santa rally. It's finally happening. I just checked. The market's gapped down like 20 points or something. I mean, that's just kind of what we're dealing with. So I think that this week in particular was simply a case of a very illiquid market. As the market figures itself out, you had a couple things in play here. Obviously, tax loss selling was definitely playing a role. And so there were some outside factors kind of pushing the market around. And in my opinion, that's why things were more difficult and not necessarily making sense. That being said, there was still opportunity to make some winning trades. But when you think about it, and you think about preserving your mental capital and how much mental capital it takes to trade something like this. When I'm trading, I want to be able to enter the trade. I want to be able to just watch it hit my targets. And obviously, this is going to sound like, oh, fairyland, Care Bear Village, where everything works out every time. But what I'm trying to say here is, when I'm entering a trade, I shouldn't be shitting my pants and it's going to be going against me, right? And that's the kind of market that I feel that we're trading in right now, where it's just so uncertain and there's fake outs everywhere. And again, it's just a liquid, slow moving price action. And so that's the type of environment where I really just chill out until things pick up. And I do think that they'll pick up at the start of January as we see some new money start to come into the market and we get that rebalancing and things kind of settle themselves. I think that January will be much, much better for traders. So I'd rather not waste that mental capital trying to trade the end of the year here, and I'll just wait until things get better. But let's talk about the technicals going into today. So I saw somebody in the comments talk about the potential sell signal. Sure, we absolutely may get that sell signal if we break down below the 50 SMA on the 30-minute chart. Let's take a look at what the hourly chart is telling us. We got the buy signal yesterday. Look like we're going to get a bullish cross. So our key level of support is going to be 38.30. So that's where the 50 SMA is on the hourly. Let's go back to the 30-minute. 50 SMA, 38.30. Perfect. They're both in the same spot. So 38.30, SPX is going to be big support today. If we open below it, that's obviously big resistance. And so below that, bears are in control. But again, guys, this is such a crazy day, the last day of the year. I personally would take everything with a grain of salt. The market has shown you so far this week, when as a trader, you have to be able to look at what the market is telling you, to be honest with yourself, to use that information in order to make better decisions. If the market is trading like this, it's in zoo mode. It's in Wild West mode. Nobody knows. I don't care who. Nobody knows what the fuck happened this week. All right. We traded in a tight range, breakdown below daily demand, and then we gap up. Oh my God, we're back above 38.40. Oh my God, Santa rally. Holy fuck. Oh, right back down. Right? So let's be honest here. I think that today is a really good opportunity to just chill out, get a 4-day weekend and not lose your ass on the last day of the year. You guys can clearly tell by my voice that I was not having it this week, but I'm pumped for January 2nd. when we get back to trading next year, or maybe it's no, January 3rd. Yeah, because we have Monday off. All right, guys. So that's my outlook. Hopefully that's kind of clearing things up for you. Hopefully it makes a little bit of sense there. All right. So let's go over to Ramsey now for Bet the Bell. Ramsey, what do you got for us?
Good morning, guys. Bet the Bell. Last one of the year. Let's make it a good one. And remember that it is not always going to be fairy tale, Care Bear, Candyland Village, as Alejandro said. It's not always rainbows and sunshine. Sometimes you got to get some rain and weather through the storm. So remember, don't fall in love with this Care Bear, Candyland, Shoots and Ladders Village, if we want to call it. So
Ladders.
moving on.
I gotta add that.
I don't know where Shoots and Ladders came in. I was thinking about Candyland and Shoots and Ladders. Anyways, all right. First question of the day: green or red? Indices rather down. We're selling off a little here in the pre-market. Skewed to the downside. What do we think today? Green or red? Noah.
I will go red. I just can't imagine 2 days of continuation in this market in the same direction. We got it. We got to go red. Green day yesterday. Got to go red.
Yeah, keep it barcoded and Christmas tree like on the daily chart. Alejandro, what do you got?
So by the looks of it, because we're trading at 380 in the pre-market, we'll probably close right at 384 again. I'm gonna go green.
Green, I love it. I would honestly love to see that. Mo, end it off for us.
Gotta pump it, huh? Last trading day of the year, so I'm going green, man. I know we're gapping down. I mean, who's surprised, right, this week? But yeah, I think we'll get a nice pump today. We'll see.
I'm gonna go green as well. I think that I'm gonna stick to this little narrative that's been playing on the daily ever since we had that first real breakdown since FOMC. Market's just still kind of been finding its base, chopping around, basically at support and previous resistance. So we will see what happens there at when the market closes. So second question, this is a good one I came up with. So I want to know, obviously in this bear market, a lot of names coming down, a lot of large names, especially in the tech space. Apple and Tesla, if both of them were at $100 today, which one would you rather add? I feel like, you gotta like 100%, the risk to reward on one of them is, you double your money and the other one could 4, 5, 6 times your money. So what are you guys thinking? Tesla or Apple at $100? Noah?
I would go with Apple. I think it's a bit safer. I think if you were to ask me like which one is going to outperform next year, I would be able to like more comfortably say Apple. But yeah, for this question, I'm still going to go Apple. To be honest, I think Tesla has a lot more downside actually before they find a base.
Gotcha. And Alejandro?
Well, I'd probably say Apple if I was about 60 years old and worried about my retirement. And since Noah wants to play this so conservatively, I'm going to have to go with Tesla. I'm 23 years old. I love Elon. Here's the thing. I think that a lot of like the Twitter FUD and a lot of like this whole Elon making these crazy political statements on Twitter, that all coupled with the fact that obviously interest rates going higher hurts any company, any car company, rather. When you have an investment horizon of 30 plus years, these are the type of opportunities, in my opinion, where if you truly believe in a company's growth, and Tesla, we know, is better positioned than every other car company. They're still growing despite interest rates going higher. The demand issues, that's going to be obvious and very difficult to deal with in this environment as the price of a car effectively goes higher. Everybody knows you buy cars with debt. And so they're going to struggle. But I think the better question is, what type of investment horizon do you have? What is your sort of risk tolerance? If you want to play things safe, I think that Apple is obviously the more obvious answer. I am a little bit more aggressive given my investment horizon. So Tesla to me is much more appealing, if I'm being honest.
It's interesting, but a good take. And last but not least, Mo.
Yeah, so Honda pretty much said everything I was gonna say. I think the safer investment would be Apple. Tesla, the riskier investment. I'm gonna go with the riskier investment, Tesla.
Honestly, I agree with you guys. I mean, look, Tesla, one of them has a 300% upside to all-time highs, the other one 80%. Obviously, there's no there's no doubt or argument which is the better company, which one runs the world, right? That's Apple, but especially in this time, and I was talking about this to Mander the other day about the crypto market in the sense that rising interest rates and overall fears of economic slowdowns just destroy speculative assets, and I think that's what we're seeing in a lot of the names in the high beta market and even in the S&P.
What do you think Tesla is?
What's that?
What do you think Tesla is? You just said the rising interest rate environment hurts, more speculative companies.
Speculative assets. I wouldn't say that Tesla's like 100% speculative, but I mean, dude, we can't just say that they're not overvalued. I mean, what was their P&E ratio a year and a half ago? At
190.
Was it 190?
I think no doubt they're
I thought it was
overvalued.
at one point it was in the 400s.
At the end of 2021, it was 190. I'm reading.
I'm saying, okay, so at the end of 2020, right? So the beginning of this year, I'm saying like around a year and a half ago, they had an over 400, P&E ratio. It just you can't tell me that it doesn't feel like some of those Tesla, those gains and how they ran so high was purely numbers based, and it wasn't speculative as well. I'm going for my grandparents, for my mother, I'm going Apple. For myself, I'm going Tesla.
I don't think there's a wrong choice. I think I was just trying to highlight that I want to be careful looking at names like Tesla, and obviously they're not going to fall directly into this basket, but like Roku's, like Shopify's, and looking at these all-time highs and saying, look at how much upside this has.
Mm-hmm.
And we may not see that environment where a Tesla could go to $1,000 a share pre-split. We may not see that for a decade, right?
So I think not see it ever again.
I think that you just have to keep that in mind. I think that's the point I'm trying to make.
Love it. So last question of the day, we're gonna have Ryan pull up this graphic, and it's a two-part question as far as this graphic that we have pulled up. So basically what we're gonna pull up is the shit stocks of the year. The high beta. Someone got to mute. The high beta shit stocks of the year. We got Carvana, Peloton, Beyond Meat, Coinbase, Teladoc, DocuSign, Zoom, Spotify, Snap, and Robinhood. Look at those numbers. Who the hell wants to own those stocks? Well, I got some news for you. You guys got to own it on the panel today. I want to know first, which one is the biggest surprise to you out of this list coming into 2021? Obviously, the high betas, just an absurd pump all of last year. And our second question is, if you had to add one going into 2023 to your long-term portfolio, which one are you taking? So let's start with Noah.
The most surprising, wow. I mean, none of them are really that surprising. I guess Spotify. I mean, I use Spotify is the only one on there that I use consistently. Chris says Coin is the most shocking. Like, I get why Coin would be shocking, but like, if you understand that crypto gets decimated in this sort of environment, Coin's not a huge shock. So yeah, I would say maybe Spotify, just relative to the other companies on there. You know what I mean? So that's why I would go with Spotify. I think all of the other ones are kind of understandable. A lot of those internet tech stocks that get their demand pulled forward during COVID, those make sense. So I think Spotify is probably the one that got me. If I had to add one into the long-term port, I'll take a page out of the risky book, and I'll go with Coinbase.
100%. Take a page out of Kathy Wood's book. She'd be happy if she was watching Beat the Bell this morning. Alejandro.
Let me know if my mic is okay here. I was having trouble.
Yeah, no, you're good.
Okay. So, biggest surprise I think is definitely Coinbase. You guys have to remember the sentiment around this stock when it first IPO'd. I'm trying not to think in hindsight here. Obviously, a year later, we can look back at the price of the stock. We can look at what happened in the crypto space, and it's kind of we all saw this coming, the crypto bubble. But think about again when the stock first IPO'd. This was supposed to be like the next big thing. The stock IPO'd at I think like $350. And I remember, and this is like peak, everything was just going higher. So when you have a crypto trading platform IPO, this was like the most exciting thing. I personally didn't buy any. I don't know how I saved myself from buying it at $350 because it did look really appealing. But again, just looking back at it, this was supposed to be the next big thing. And to see it have sold off 92%. If somebody told me Coinbase is going to sell off 92% over the course of the next 12 months, I genuinely would not have believed it. Because compared to all the other companies listed here, it's the one that stands out as having that sort of potential to be massive in the future. But Bitcoin going to shit obviously really put a damper on things there. If there was one that I would add, and I don't want it to be Coinbase, probably go with Spotify. Honestly, I think I'm with Noah there. Shout out TCP, Trading Camp Pod on Spotify. That'll be my reason. I mean, they're all really bad companies, man. I don't have much to say about which one and why. It's kind of tough to justify adding any of these.
Mamba.
All right. So what's the question exactly? Because there's like two different. There's multiple
Biggest
answers.
surprise, and which one would you add if you had to going into 2023?
All right. So the most surprising on here, I'm with Hondo on this one. I think Coinbase, pretty much everything on this list was a COVID pump. Carvana, Peloton, Beyond Meat, T-Doc. I know someone from the viewers mentioned T-Doc in the healthcare, but remember that's 2020. That's a COVID pump. So not too surprised with that drop. DocuSign, same thing. Zoom, Snap, Spotify. I get it, Noah. I get why you picked that. Robinhood. We're not even going to get into Robinhood. You know Robinhood's history. We're not going to get into that. But if I would pick one to end up investing in at when they're down this bad, I would say Coinbase. I don't think the crypto movement is over, in my opinion. So I would stick with Coinbase, and I am surprised how much down they are. There was a lot of hype around it, but again, a lot of news comes out. That market is very news driven. I mean, you get huge movements off of any sort of news that comes in, but just due to my own, analysis and opinion, I think, the crypto bubble, one could say, is not over. And I do think Coinbase will have a nice run.
Beautiful. Love to hear it. Remember, guys, Jim Cramer, Coinbase, it was a buy at 400. And about 3 weeks ago, when it was trading at $35, $38, it was too early to buy. So just keep that in mind, the famous Cramer Coinbase call. So that's going to do it for Bet the Bell. We'll pass it back to Alejandro.
Sweet. All right, we're going to do some flow now with Mo. Mo, you got anything good for us?
Yes, sir. So we're going to look into someone's mic. All right, there we go. All right, so Qs, guys. Qs, I noticed this. I kept mentioning this in the Discord yesterday. Qs put flow just kept coming in yesterday. I did filter it out to 100K plus premium, as you can see right here, which piqued my interest, right? These are for next week. These aren't 0DTEs. These aren't Mondays, Tuesdays, Wednesdays. These are for next week. So these have time to play out. When I do usually see these type of flows come in for next week's, more than likely they do end up playing out, but they have some time on them, right? It's not an initial move. It's not that 1 DTE, that 2 DTE, that 0 DTE type of, huge premium coming in. You're expecting a move right there and then. This type of buys that come in, from my experience, is, they do end up playing out, but not the same day. It might be Tuesday or next Wednesday, right? They do end up playing out. Now, let's take this flow. I mean, even if we look at, remember last time I talked about SPY, January 20th, expiration, even on the 20th, yesterday, right? The majority was puts that was coming in. The majority was puts. You have a few call flows coming in, but overall, it's bear dominant. The flow is bear dominant for January 20th as well. So let's look at the chart right now. In the Qs, we did hit a supply zone, nearly hit the supply zone on the Qs. Maybe we can bring it down right about there. It looks like we rejected the low, the very low of that supply zone. We'll probably bring it down right about there. But the big level I'd look out for is if we do turn around and make a run up, is this 269.65, the peak of this supply zone. I really do like puts up here. If we do come up here and reject this zone, I'm looking to swing some puts. But if we close above, you know, I'd have to watch out, watch the next day, see how the next day plays out. If we fail to hold support, again, I still like swing puts. So those put flows that are coming in, I mean, who knows if we get a run up today or if we just fall through, but very interesting. And then January 20th is understanding because we are still in a macro bear market. You know, that's not too surprising. But yesterday when that put flow did come in, I was kind of surprised, especially with the gap up we had yesterday and the strong run. You might see some sort of minor pullback. I was not thinking we'd see that steep of a gap down, maybe some sort of minor gap down and then a run up, but who knows what the market is going to do today. Let's see how that plays out. But and we'll look back at these January 6th put flow and see how this played out. Thanks, Hondo.
All right, awesome. Thank you, Mo. We're going to wrap up the show here, guys. It is 9:07. Thank you all for joining us. This is, of course, the last episode of Beat the Bell for 2022. Looking forward to 2023. We'll see you guys back here on Wednesday morning at 8:30 a.m. Eastern Time. Have an awesome trading day and have an awesome weekend, everybody.